Okay, finance experts, now we want to talk about pricing stocks. Okay, we talked about pricing stocks and bonds, we talked about pricing any financial asset. So the price or the value of any financial asset is the present value of expected future cash flows. So for any financial asset, you take the cash flow in year one, or period one, discounted back 1 year for the return on an investment of like risk. Cash flow in year two, or period two, to the second power up until the end of the life of the investment. Okay? So you discount back all of the cash flows. So the cash flow in period M discounted back at 1 plus R to the M. So the price of any financial assets, the present value of expected future cash flows. R, how do you get R? The return. It's always a return on an investment of like risk. We go back to our risk-return relationship. So before we price a stock, let's go ahead and talk about pricing any financial asset. I'm thinking about buying a piece of rental property across the street from campus. I can buy a piece of rental property across the street from campus that has expected cash flows of $50 the first year, $50 a second, and $50 a third. So I'm looking at buying an investment that's going to pay back, I expect, as of today, $50,000 a first, $50,000 a second, $50,000 a third. I want a return on an investment of like risk. I want a return of 10%. Assume that investments of like risk are given 10%. That's a return of one on my investment. And assume that the person selling the house wants to sell it for $110,000. So the person who wants to sell it wants $110,000 for it. I think I can generate $150,000 in cash flows over 3 years. The problem is I'm going to have to wait 1 year from today to get the first cash flow, and 2 years from today to get the second cash flow, and 3 years from today to get the third cash flow. So what am I willing to pay for that real estate? I'm willing to pay for it what it's worth. So I expect $50,000 the first year. Let's discount it back at 10%. $50,000 a second. Let's discount it back at 10% for 2 years, and $50,000 discounted back at 10% for 3 years. So I calculate the price of this piece of rental property. I calculate the price based upon expected future cash flows in the numerator and my expected return in the denominator. How do I get that return of 10%? What else can I do with my money? I always consider opportunity costs. I can get very little from a savings account. I can get very little from a treasury security. I'm thinking a 10% return is a good return for stock, real estate. That's what it's been returning in Hammond over the last several years. I think that's a fair return. That's a return I can live with. That's a return I'm willing to take the risk for. So what we do is we discount back the cash flows. Of $50,000 discounted back at 1.1 to the first is $45,455. Always check the work. Make sure you're getting these exact same answers. Or have rounding, could be off because of rounding, but make sure you get something close. $50,000 discounted back at 1.1 to the second is $41,322. $50,000 discounted back at 1.1 to the third is $37,566. So I'm willing to pay $124,343 for this investment. I say that this investment, this piece of property, has these expected cash flows of $50,000, $50,000, and $50,000. When I want a return of 10% on my investment, I said that those cash flows are worth $124,343. The person selling a piece of property only wants $110,000 for it. I want to buy that investment. That's what we refer to as an asset that is underpriced. It's worth $124,000 according to me, and the seller wants to sell it for $110,000. So I priced that financial asset. I said that this investment is undervalued. I want to buy that investment. You may have different expectations. You may go look at that piece of property and say, hey, I don't think it's going to generate $50,000 in rental property income. You know, Southeastern may be going to online, and students are going to take the classes online, and we're not going to have anybody living in Hammond, and I think this piece of property is going to generate $25,000, and there's a lot more risk than 10%. I should get 20%. So you may use a different return. So we don't have to agree on price. You have different expectations. You're going to come up with a different price. Remember, equilibrium's where supply and demand are equal, where it crosses. Okay? Doesn't mean everybody agrees on price. So here's an example of pricing a financial asset. We're pricing a piece of rental property, and we discount back the cash flows. Now let's go to stock. How do we price any financial asset? Present value of expected future cash flows. So how do I price my stock? Well, the price of the stock, or the value of the stock, is the present value of expected future cash flows. For the stock, we call it dividend. So we take the dividend for the first year. I'm just going to assume annually. The dividend for the first year, discounted back at 1 plus RS to the first. The dividend the second year, divided by 1 plus RS to the second. Basic time value of money equation. Plus, the dividend in year end, that's how long I'm going to hold the stock for, divided by 1 plus RS to the nth power. So discount back all my expected dividends. Anytime we talk about the future, we're talking about expectations. So this is expected dividend the first year, the dividend I expect the second year, the dividend I expect in year end, plus the selling price. When I buy a share of stock, I may get dividends. Stocks usually pay cash dividends, and I expect it to sell it for something. This is the selling price in year end, divided by 1 plus RS to the n. This is to the nth power. Okay, so we discount back the cash flows. How do I get that return on stock? Well, we come back to our basic risk return diagram. Here's risk on the vertical, horizontal axis. Here's return on the vertical axis. A return on the bond is going to have less risk and therefore lower return in the stock. So we distinguish between return on bonds or returns on stocks. Why are bonds going to have lower risk? Because bondholders are paid first. Bondholders, if you look at your income statement, bondholders' interest is paid before taxes are paid, before net income, which belongs to shareholders. So let's go ahead and do an example. I'm looking at buying a share of stock. This stock, I expect a dividend of $1 a year from today, a dividend of $2 2 years from today, a dividend of $2 3 years from today. I expect to sell it in 3 years for $50, and I want a return of 10% on my investment. I'm using 10%. It's a real easy number to work with. Okay, so I'm using 10%. But again, we always go back to our positive relationship between risk and return and see where we fit on this diagram. Okay, so when you go sell your skills in the marketplace, you're going to look at opportunity cost. So an undergraduate business major with an average GPA of say 3.0 starts out at $45,000. You're above that, you expect higher compensation. You're below that, you expect, or you can't expect, average compensation. You can expect lower compensation. So we always look at opportunity cost, okay? Return on investment of like risk. So here we assume a 10% return. So I'm looking at this stock that has these expected cash flows. Dividend 1 year from today, 2 years from $2 2 years from today, $2 3 years from today. I expect to sell it for $50, and I want a 10% return. Put it into our pricing model. We price in stock. We value in stock. So we're going to price it at what? Well, what's the value? What am I willing to pay for it? I'm willing to pay for what it's worth. So we discount the $1 back at 10% for 1 year, $2 at 10% for 2 years, $2 at 10% for 3 years, and $50 at 10% for 3 years. Now these two I can add together. I can add my 50 and 2 to get 52 and discount it back 3 years because it's the same point in time. Here, I can't do it because this is year 2 and this is year 1. And from your principles of finance class, you can draw your timeline. Okay, so you can look at, you can draw your timeline. So let's go ahead and figure out $1 a year from now. What is it worth today? 91 cents. $2 2 years from today at 10%. What is it worth today? $1.65. $2 3 years from now at 10% is worth $1.50. $50 at 10% for 3 years is worth $37.57. Make sure you get these same numbers. Make sure you discount back the cash flows and get these same numbers. So if I add these 4 numbers up, I get $41.63. So what am I willing to pay for this stock? I'm willing to pay $41.63. That's what it's worth. That's the value of the stock. Okay? So that's how we price a share of stock. We discount back the cash flows. Very simple concept. Now what I'm paying you for is figuring out what the expected dividends should be. What I'm paying you for is figuring out what the selling price should be. What I'm paying you for is figuring out a fair return on investment of like risk. So everybody's going to use the same pricing model. Everybody's going to use the same equation. Everybody's going to discount back cash flows. What I'm asking you to do is to figure out what is a realistic number. Okay? What's a realistic number for dividends? What's a fair return for an investment of like risk? What's a fair selling price? So if you sell homes for a living, you're a real estate agent, I come to you and I'm asking you for your professional opinion. What can I get for my home? Here's the square footage, here's the location, this is the type of roof I have, this is the type of floors I have, here's my school district, what's a fair price? And if we don't price it correctly, if we have too high of a price, I never sell it. And if it's too low of a price, then I didn't get what it was worth. It was a loss in terms of opportunity cost. So this is what I'm paying you to figure out is what these numbers should be. So let's go ahead and do an example. Let's try to figure out what these numbers should be. So what I want to do is I want to come up with the price for Home Depot stock. Price for Home Depot stock. I like Home Depot stock. This is a stock we have in our Haywood Gibbs portfolio. This is our student managed fund that we have on campus. And this is one of the investments we have. So it's a good stock. We're all familiar with Home Depot. We have an idea of what they do. You probably have been into a Home Depot. So I want to price Home Depot stock. Let's figure out the fair price for a share of Home Depot stock. Okay? Well, currently, I looked it up on Yahoo, and it's currently selling for $131.93. So the current price is $131.93. Now let's figure out if that's a fair price. Let's figure out if it's overpriced, underpriced, or fairly priced. Okay? In finance, we're always looking for good deals. Okay? But if you know how to price things, and I know how to price things, then good deals don't exist. Only fair deals exist. So we're looking for that good deal, but if people have information, if we have competitive, complete, perfect, well-functioning markets, we're not going to find a good deal. We only find a fair deal. So there we want to make sure we get a fair deal and make sure we don't get a bad deal. Okay? So they tell us that information is power. And we don't want somebody to take advantage of our ignorance. So we want to come up with the price for Home Depot stock. What am I willing to pay for it? As an investor, I want to pay the correct price. I don't want to overpay. As a corporation, how do you raise money to buy assets, to generate cash flows, to maximize shareholder wealth? Well, as a corporation, you buy money, you raise money to buy assets by selling stocks and bonds. You don't want to sell it for too little. You don't want to sell your stock if you're Home Depot. You don't want to sell your stock for 100 when people are willing to pay 131 for it. You want to sell it for 100 when it's worth 131. You lose in terms of opportunity cost. So whether I'm buying the house or selling a house, whether I'm buying a car or selling a car, whether I'm buying a share of stock or selling a share of stock, I have to know what the fair price is. I want to figure out the fair price. If I'm buying it, to make sure I don't pay too much, pay as little as I can. If I'm selling it, I want to get a fair value for a fair price for my asset. So let's see if 131 is a fair price for Home Depot stock. So what I did was I went to Yahoo Finance. So I went to Yahoo Finance to get some information on Home Depot stock, just like buying a home, just like buying a car. You want to sell a used car. How many miles does it have? What type of car is it? Do you have new tires on the car? Do you have any dents? So I want to get some information about your car before I figure out what I'm willing to pay for it. So I'm going to do the same thing for Home Depot stock, okay? So the first thing I did was I went to Yahoo Finance, and I noticed that I found that the earnings per share was $5.69. So the last 12 months, so this stands for the trailing 12 months, earnings per share was $5.69. So the last 12 months, Home Depot made $5.69 for every one share outstanding. They paid a dividend over the last year of $2.76. So they paid a $2.76 dividend off of $5.69 of earnings. Well, where did the rest of that money go? Well, you remember from accounting class, net income belongs to shareholders. I can either pay it all in the form of a dividend or retain the earnings. I should say I can pay some of it, all of it in the form of a dividend, or I can retain some of it, or retain all of it. So what Home Depot is doing is they're making $5.69 per share, paying out $2.76 per share. So I wanted to figure out a payout ratio. The payout ratio is what percentage of earnings per share are they paying out. So I took the dividend per share divided by earnings per share. So this is the dividend per share. This is on a per share basis. The dividend per share divided by earnings per share. So they're paying out about 50%. Paying about everything they earned the last year, what they earned, they paid out about 50%. So they put the other 50% back into the business. We call that the plowback ratio. The plowback ratio is what we plow back into the business, what we put back into the business to retain those earnings to grow the company. Now again, from the accounting class, in theory, retained earnings is what's left over of net income after we pay dividends. It's not a cash flow, okay? It's not cash flows. So we understand that, but we're trying to have an idea, how much is the company putting back into the business to grow the company? So Home Depot's paying about half of their earnings out in the form of dividends to shareholders. They put the other half back into the business. So the payout ratio is about 50%, 48.5. The plowback ratio is a little bit more. So if I go straight off of this number, okay, 48.5, so I'm going to round this to say 49, then they plowing back about 51%, 51.5% back into the business. So again, the payout ratio is what percentage of earnings we're paying out. The plowback ratio is what percentage of the earnings we're putting back into the business. So for example, if a company has net income of $100 per share and pays out a $60 dividend, by definition, it's putting $40 back into the business. It is paying out 60%. It is plowing back 40%. It's plowing back 40% of earnings back into the business, paying out 60% to shareholders. So what I did was I went to Yahoo Finance, and I noticed that they earned $5.69 per share. They paid out $2.76. Their payout ratio was about 50%. Okay? Then I'm thinking, well, let's see what their income has been doing over time. So I just went back 1 year. So I found on Yahoo Finance, I found net income of $7.009 million. So about $7 billion. So it was $7.9 billion in net income for 2016. So this is off of Yahoo Finance. This is off of the income statement. And net income for 2015, the previous year, was $63.45 million. So $6.345 million. So what I did was, just out of curiosity, I wanted to figure out what the percentage increase was. So the income grew about 10% from 15 to 16. So I'm assuming, well, let's assume that's going to happen again. Let's assume that income is going to grow about 10%. If income's growing 10%, earnings per share is going to grow about 10%. So what I did was, off of this 569, I let my, so I had over the last year, the trailing 12 months, the earnings per share was 569. I took 569, assumed it was going to grow at 10%, just like that income has grown. And that comes out to $6.26. So I expect earnings per share a year from now to be $6.26. I expect that my earnings per share are going to grow at this 10%. So a year from now, I expect $6.26. 2 years from now, I expect $6.89. 3 years from now, I expect earnings per share, anytime we go into the future, it's expected, I expect earnings per share 3 years from now to be $7.57. So what I did was I looked at what we currently earn. So this past year, trailing 12 months, so last year, this is what it earned, okay? So this is this year's earnings per share, trailing 12 months. In the most recent year, it paid $5.69. Over the last year, net income has grown about 10%. I'm going to assume that earnings per share are going to grow at 10% every year. So 5.69 times 1.1 is going to leave us with 6.26. And that 6.26 times 1.1 is going to grow to 6.89 times 1.1, 7.56. So it's just a future value equation. Future value is present value times 1 plus r to the t. So it's just a future value calculation. Now what I've done is I've looked at over the last year, I've noticed that it paid out about 50 cents in dividends. So I expect the dividend 1 year from today to be $3.13, so half of this. And I expect the dividend 2 years from today to be $3.44, I had a round, and that's half of this. And I expect the dividend 3 years from today to be $3.78, and that's half of this. So what I did was I have to come up with expected cash flows. I want to buy Home Depot. Home Depot is currently selling for $131.93. I want to see if that's a fair price. If it's overpriced, I don't want to buy it. If it's underpriced, I want to buy it. I want to buy as many as I can. Okay? Is it worth the $131? So I said, let's look at history. Let's look at what has happened. Well, this year paid a dividend. This past year paid a dividend of $5.69. So the current dividend, earnings per share, earnings per share is $5.69. So it earned this past year $5.69. The dividend it just paid over the last year was $2.76. So it's currently paying a dividend of $2.76, which it earned over the last year, earned $5.69. We looked at what net income was in 2016 from the income statement from Yahoo Finance. We looked at 15. We took the percentage change, so ending minus beginning over beginning. Ending minus beginning over beginning is how we calculate any percentage change. And I get about a 10% increase. Okay, it's a little bit more than 10%, but about a 10% increase. Okay, so I'm rounding it to about 10%. So I said, okay, if earnings per share is this, let's let it grow at 10% for 1 year. Grows to 626, 2 years to 689, 3 years to 757. If it's been paying out half of its money in dividends, half of its earnings per share goes to dividends, we can assume that's going to be the case. So here are my expected dividends. So now, if I want to buy the share of stock, I expect a $3.13 dividend 1 year from today, a $3.44 dividend 2 years from today, a $3.78 dividend 3 years from today. What do I expect to sell it for in year 3? Well, what I did was I went back over the last 3 years and looked at Home Depot stock price, and it went up about 20%. So over the last 3 years, Home Depot stock went up approximately 20%. Well, I'm thinking that was a nice run. That was a good time. The market was doing well. The economy was doing well. I don't expect it to continue at that pace. So I'm going to assume stock price is going up by about 15%. So I'm going to assume over the next 3 years, the stock price is going to go up by 15%. And these are just my expectations, right? When we price a share of stock, we're looking at expected future cash flows. What do I expect the future cash flows to be? What's a fair return on an investment of like risk? I'm trying to figure out if I want to buy it, if I want to pay that price for the stock. So even though it's been growing at 20% over the last 3 years, I'm going to assume it's going to grow at 15%. I think that's a conservative estimate. I think that's a realistic estimate. I think 20% is not possible. I don't think Home Depot can keep growing. So what I did was I took my price of $131 that it's currently selling for, and I'm assuming it's going to grow at 15%. So it's going to grow to about $200. Okay, so I'm going to assume that it's going to grow to about $200 over the next 3 years. Okay, and that's just an expectation. Now, what return do I want on my investment? What's a good return for Home Depot stock? Well, let's take a look at history. So I'll go back and look at, I just Googled stock returns, historical stock returns, and I found that the S&P 500 returned over different time periods, different numbers. The S&P 500 is supposed to represent the U.S. economy. It's 500 securities that represent the U.S. economy, and it gives me an indication of how well the stock market is doing. It's a proxy for the stock market. So from 1928 to 2015, the S&P 500 returned about 11.4%. From 1966 to 2015, about 11%, and over the last 10 years, about 2006 to 2015, about 9%. If we look at gas prices over the last 3 months, over the last 6 months, 3 months, 2 years ago, okay, a 3-month period 5 years ago, you know, what was it selling for, you know, in March 5 years ago? So the price is going to change, returns are going to change, the economy's, the world's changing. So here are the historical returns on the S&P 500, which is a proxy for the U.S. stock market. I'm thinking that Home Depot is going to be more risk than an average stock. The S&P 500 is an average stock. Okay, it's the stock market in general. So I'm thinking it's going to be a little bit riskier. So I think it should be about 12%. So the return I want on my investment of like risk is 12%. So again, I go back to my risk return diagram. Okay, so we go back to the risk return diagram. So I assume that if this is going to be the S&P 500, I think my return on Home Depot stock should be a little bit higher. So I'm going to call this, S&P 500 return. I'll call this Home Depot stock. So no matter which number I look at, anywhere from 9 to 11.4, I think Home Depot stock is going to be a little bit riskier. So I want a 12% return. So what I'm going to do is I'm going to discount back my cash flows at 12%. So I estimated the dividends in year 1, 2, and 3 based upon what has happened historically with Home Depot stock. I expect that my net income is going to grow about 10%, therefore earnings per share is going to grow at 10% each year. I'm assuming my payout ratio is going to stay close to 50%. I'm assuming that the dividends are going to be half of earnings per share. The rest of the money is going back into the business to get that price up from 133 to 200. So now I discount back my cash flows. 3.13 divided by 1.12 to the first. 3.44 divided by 1.12 to the second. 3.78 divided by 1.12 to the third. And 200 divided by 1.12 to the third. I get a price of 150.58. I think Home Depot stock is worth 150.58 based upon my expectations, based upon what I want on a return on investment of like risk. And you'll say, well, look, that stock is risky. There's uncertainty involved. I agree. That's why I want 12% of my money. So a treasury security is paying very little. Your savings account's paying very little. I gave that example of real estate expecting a 10% return. Okay, that's just a number I came up with. So I'm thinking that 12% is a fair return. It's risky, it's uncertain, so I'm going to discount back my cash flows at 12%. I get a price of $150. Look, in terms of dollars, okay, this is almost 4, around these 2 to 3. So 4 and 6 is 10. So I'm getting back, what, 210, more than $210, okay? So I'm getting back more than 210 over 3 years. I'm willing to pay $150.58 for it, because that's what those cash flows in the future are worth today, assuming I want a 12% return on my investment. So I say the stock is worth $150.58. It's currently selling for $130.193. I would say it's a buy. So if I were an analyst, I would give this a buy recommendation. I think it's worth this. Stock market prices are here. I would put that as a buy. I would say it's undervalued. Now, does that mean that I don't agree with the market in general? Yes. Who's right? Well, time will tell. What if this price stays at 131? What if the market believes that's the fair price? Well, they have different expectations in terms of expected future cash flows and or a required return, right? So from your present value equation, present value is equal to future value divided by 1 plus r to the t, right? So we write this here. So the present value equation is future value divided by 1 plus r to the t, from principles concept. So if I expect a higher return, then the price is going to go down. So the market maybe wants a higher return. The market may want a 14% return. So that's going to drive this up, driving the price down. So why does the market price it at 131 when I say it's worth 150.58? They may have different expectations for cash flows or different required return. If they have the same expectations for cash flows, if they did it exactly the same way I did, then they want a higher return. So when the required return goes up, it's going to drop the price down lower than this to this. Okay? So that's how we price a share of stock. This is going to be the first way of doing it, just discounting back the cash flows. And then we'll talk about the constant growth model. I'll show you the constant growth model in a minute. Okay?